Do golden and death crosses matter? Let's break it down. Hey everyone, welcome back to Upside Down Data. Today I'm bringing you a special video in collaboration with Jay over at Daily Crypto Analysis. Highly recommend you check him out if you have not already. And in this video, what we're going to be talking about is, do golden crosses, which are typically defined as when the 50-day simple moving average crosses above the 200-day simple moving average, and we just had one back here late October of this year, do they actually matter? Do they actually predict positive returns like a lot of people think? And also, are they different from death crosses, where the 50-day SMA crosses below the 200-day SMA? And do death crosses actually predict negative returns or not? And so what we're going to be doing is we're going to be looking at data from across thousands of crypto assets to answer this question. So Jay is going to go ahead and break down what these numbers look like in aggregate and more in raw terms. And then I'm going to present some additional analyses that talk about, can we actually conclude that there's a meaningful signal coming from these indicators, or is it all just due to random chance? So I'll hand it over to Jay, and then I'll be back later on in the video.
So let's talk about the analysis that we did. So in total, we collected 3,178 Golden Cross examples. And conversely, when we looked at all of the different coins that we collected throughout the history of the cryptocurrency market, we came up with 3,360 death crosses. Now, when you look at all of the different assets that we have, it turns out that on average, throughout the entire lifespan of all of the different coins that we looked at, on average, there were 3.8 Golden Crosses per coin and 3.9 death crosses per coin. So we did this in two different analysis groups. I looked at all coins, so in other words, every coin that we collected, and then I compared that to looking at only the top 100 coins. When the event occurred, was the coin within the top 100 or not? All right. So we wanted to look at the difference between those two different cohorts. So what we did then was collected the 10, 20, 30, 60, 180, and 365-day returns after each event. So in other words, if a coin had a Golden Cross event, what were its returns over these periods of time? Okay. And then conversely, if there was a Death Cross event, what were its returns over these various lengths of time? Okay, so here we have the Golden Cross and the Death Cross, and we're looking at all coins. Now that's going to be a key point to make here. We're looking at all coins here. So when we look at this, you'll notice that no matter whether you're looking at a Death Cross in yellow or a Golden Cross in green, the results are actually negative. You're actually expecting negative returns after a Golden Cross or a Death Cross. And contrary to what you may expect, a Golden Cross has lower returns than that of the Death Cross. And that is true across every time frame other than the 365-day level. Now, remember, guys, this isn't data that we're just, we're not just making this up and cherry picking a few coins here. We're looking at the entire cryptocurrency market. We're looking across a time span of 9 years, 9 to 10 years at this point. Okay. So this is just objective data. We're just showing you the results. I know a lot of people may be already scoffing at this, saying this can't be right. I don't understand. I don't understand how this is possible. But give it a moment, and I think we can possibly figure out what's going on here and why this is. But I think a lot of things are just going to prove that ultimately this signal functions in a way that's contrary to the way that a lot of people expect it to. Now, the number one there's two striking things here, obviously. The first is, no matter whether you're looking at a Golden Cross or a Death Cross, you're seeing that the returns are negative. The second thing is, across 10 days all the way up to 180 days, they're both negative, but relative to the Golden Cross, the Death Cross has significantly higher returns. Okay. That is not true, however, when you look at the 365-day time span, and you actually see a marked flip here. So the Golden Cross at the 365-day level is going to be around negative 17% returns, whereas the Death Cross, you're actually expecting around negative 33% returns. So what's actually happening here? And, I've kind of laid out this key point, and that's that the Golden Cross, when you're looking at a wide range of coins, remember, when we're looking at this massive number of coins, we're talking about a lot of coins which are relatively lower in value, right? So we have a lot of scam coins, coins which are essentially owned by just a few individuals, so the entire supply is owned by a few individuals. And oftentimes what you're seeing here, I suspect, is the fact that these lower quality coins, when a bullish signal occurs, they use retail investors FOMOing into the coin, expecting additional positive returns by looking at signals such as the Golden Cross in this case, and going into that coin. And then these large token holders, the developers, the VCs, they use the retail market as exit liquidity. And that's why we're seeing that when we have a Golden Cross in a large number of examples here, essentially from 10 days all the way up to a half a year, you're seeing that the Golden Cross for the median value across all of the coins that we looked at, it actually has a negative result. Okay. So why is it then that the Death Cross has a better result? And that's probably because of the fact that these coins that have already had a large sell-off. Now remember, for a Death Cross to occur, you have to have had a bearish market movement prior to that, right? That's how the 200-day is going to cross above the 50-day. So typically when you get a Death Cross, that indicates that the price is on the decline. It's harder for VCs, for large token holders, for developers to dump onto retail investors when the price movement is overall negative, right? So I think that's what you're seeing here. And remember, this is when we're looking at all coins. So what about the higher quality assets then? Now we're talking about coins that were in the top 100 at the time of their cross, right? So now we see that still the Death Cross is a more bullish signal, contrary to popular belief, over the shorter time spans. But when we get out to the 365-day level, that is where it becomes significantly in favor of the Golden Cross. And so what's that telling us? This very likely means that, these are stronger assets now. It's in general, they're still easy to manipulate, but much more difficult to manipulate than coins when you start getting out to coins that are in the top 500 or top 750, right? Is much easier to manipulate micro caps than it is to manipulate a coin that has a much larger holder base. And so what we're seeing is that the Death Cross actually tends to be bullish for these coins. And why is that? The reason is it's much harder to continue to drive a price down that's already moved down significantly. Once everyone's panic sold and you've had the Death Cross event play out, oftentimes, what do you see over the next month or the next 2 months, the next 3 months, right? You will often see a bounce. So you'll see a coin decline in value, and then we typically are going to see some type of bounce. And that holds true now when we're looking at coins that were in the top 100 at the time of their Golden Cross or Death Cross. You'll see that pretty much holds true across all these time frames, all the way up to 180 days. Now, it's not until you get out to 365 days after a Golden Cross event that we see the real difference between these two. Because now the Golden Cross, you're expecting something on the order of 36, 37% on, and we're talking about a median value here. You're expecting a 36, 37% median return. And remember, this is across the entire history of the crypto market. At that same time, now you're expecting to see negative results from the Death Cross. So this is kind of indicating to us that whether we're looking at all coins or whether we're looking at only the top 100, it doesn't really favor the Golden Cross until you get all the way out to the 365-day return level. The Death Cross is actually a more short-term bullish signal than the Golden Cross is, okay? And that makes a lot of sense. When something goes on a large rally, that's when you get a Golden Cross, okay? And that also tends to be where your retail investors tend to FOMO in, and you see that time and time again. How many times have you watched a coin go on a rally, maybe a golden cross occurs in this case, and then we see a big sell-off. It happens time and time and time again. So what that's indicating is we might not see positive returns in the short term after a lot of these coins go on these large runs and then make a golden cross. But in the longer term, in general, this is indicating that the market is positioning itself in a manner such that we're likely going to see longer term positive returns from these golden cross events. Okay. So when we just look at these side by side now, you'll see that when we're comparing all coins to the top 100 coins, the golden cross median returns for each of these, you'll see that in these shorter time frames, it doesn't really matter whether you're looking at larger market cap coins, right, or the lower market cap coins. They're both pretty poor results in the shorter term. It's not until you get out here to the 90-day, the 180-day, and the 365-day where you really start to see the quality difference. And if we look at the death crosses, you know, for the top 100 coins, like we said before, it's the results are actually fairly decent across the board, small positive returns. And that's because of the fact that for the larger coins, after there's been a large sell-off, you tend to see a little bit of a rally, right? And that's exactly what the results are telling us. So it's just essentially telling us that when these coins go on large sell-offs, you may expect, if you're just using the signal in and of itself, you may expect small positive returns. But when you get out here to the smaller coins, it's the same thing. When you start to get out to 365 days, right, just like after a golden cross, the results are pretty abysmal. So how can we actually gain any value from this signal, the golden cross and the death cross? And this is a very interesting result. So one of the things that we know is the fact that Bitcoin, when it's above its 20-week moving average or when it's below its 20-week moving average, tends to be a very strong indication of whether you're in a period of time where the market is showing bullish momentum or when it's showing bearish momentum. So simply using one additional signal. So we're taking our golden cross and death cross events and we're adding one signal to it. And we're saying, is Bitcoin at that point in time above or below its 20-week moving average? And let me show you what I mean by that. So here we have Ethereum. So we still have our golden cross and death cross. So here in green, we have our 50-day moving average, and in red, we have our 200-day moving average. So when Bitcoin is above its 20-week moving average, which is in blue here, and Ethereum makes a death cross, let's say, what are the results? All right. And so we're just showing the results for this one individual event here. And you can see they were incredibly good results when there was a death cross at this point and Bitcoin was above its 20-week moving average. You saw that Ethereum had 759% 180-day returns and 2,973% 365-day returns. So that's all we're doing here. And we're going to apply that to every single coin that we looked at. And I think the results are actually pretty shocking what we find. So when we look at a death cross, so we're talking now, remember, when we say death cross and Bitcoin above the 20-week moving average, we're talking about a death cross for like Ethereum or Solana or random altcoin number 795, right? That coin has a death cross. And then we just ask, okay, when that happened, is Bitcoin above its 20-week moving average or is it below its 20-week moving average? And here are the shocking results. So for all coins, when Bitcoin is above its 20-week moving average, look at what the results are for the 180-day and the 365-day returns. That's huge. Let's quickly go back here and just see. Now, remember, this is a death cross event, a death cross. And this is an important point here. I can't stress this enough. This is a death cross, but Bitcoin is above its 20-week moving average. Let's go back and quickly look what a death cross meant for all coins on the 365-day level. Well, typically you're expecting around minus 33%. But when we look at a death cross and Bitcoin is above its 20-week moving average, that is a massive signal in the market. So what about the higher quality assets then? What happens in that same event, a death cross, when Bitcoin is above its 20-week moving average? And now you see the results again are insane. And we're talking about the top 100 coins here. So 35% in the 180-day median returns and nearly 185% in a 1-year return. That's the median level. And again, we're talking about a death cross. Compare that to the golden cross under the same series of events with Bitcoin above its 20-week MA. You'll see that it crushes the results in both cases. So whether we're looking at altcoins where a death cross occurs compared to a golden cross, so it's not even close. Now, what does that mean? Why is that? All right. And I think the reason, again, is very simple. When you wait for this event to occur, this signal to occur, what you're doing is you're saying, okay, Bitcoin right now is above its 20-week moving average. And we'll just come back here and look at this. Bitcoin is above its 20-week moving average. What does that tend to indicate? That tends to suggest to us that the market is positioning itself to go on a huge rally in the future. So when you get this golden cross, when you get this death cross, what's happening is a lot of the altcoin money is moving into Bitcoin. You start to see bearish momentum in the altcoin market, bearish momentum. So like right here, we have bearish momentum, prices declining from around, in this case, $14 all the way down to around $7. When that death cross occurs, Bitcoin goes on a run, and then some of that money starts to feed back into the altcoins. So you get this kind of twofold event. You are finding altcoins that have had a death cross when Bitcoin has had its golden cross, and that suggests that those coins are selling off. In other words, they're at a discounted price. And then when Bitcoin goes on its run, money, in other words, profits coming from Bitcoin move into those price depressed altcoins. And that is how you arrive at these results. These results, when you're looking at altcoins, remember, we're looking at coins all the way down to 800, 900, 1,000 on the market cap list. And even those, when we look at the median results, you're getting 77% median returns, even from a lot of these completely garbage scam coins. So this is significant here. And I think this is the best way to use a signal like this. It's not necessarily looking at trying to use the signal at just any point in the market. It's all about contextualizing the signal, contextualizing where the market is at, and then using that to understand when the signal plays out in a particular way. In other words, when a death cross occurs, so that means you have poor price movement for an altcoin, but the market is still showing strength, that is an opportunity. Whereas when you just, look at this, when it makes a golden cross and Bitcoin is above its 20-week MA, well, you've probably already missed the boat. So once it makes that golden cross, now even the other retail investors are going to be dumping onto you, using you as their exit liquidity. And that's what we see across all time frames. The values are negative, no matter if you're looking at 10-day, 60-day, a half a year, or a full year. The values are negative when you're looking at all coins. And then when you come out here to the top 100 coins, even these shorter to medium term timeframes, these have negative results. It's not until you get out here all the way out to 365 days that you might see positive returns, 88%. Still nothing to scoff at. The optimal time to be moving into these altcoins tends to be when they make a death cross. In other words, they sell off and Bitcoin is above its 20-week moving average. So this just shows that, you can absolutely crush the expected 365-day returns, which are pretty poor overall, for all coins, and not even that great for just the top 100 coins. Remember, around 36, 37%. You can annihilate those results if you're looking at the top 100 coins and you're waiting for those coins to kind of sell off during times of market strength. In other words, when Bitcoin is above its 20-week moving average. So in other words, timing your market entry this actually is a fairly strong signal. So with that said, guys, I'm going to pass it over to Mark, and he's going to perform a more detailed statistical analysis of the Golden Cross and Death Cross.
Thanks for that in-depth breakdown, Jay. I want to now talk about this question. So when you have a signal like a Golden Cross or a Death Cross, and you observe some kind of mean return or median return, would you expect to observe that just due to random chance alone? Or does it mean that that technical indicator is actually getting at something real, and that you would actually be able to conclude that these technical indicators are actually telling us something that's more about the markets and not just something that would just happen due to random chance or error? So to get in this, I want to break this down by first giving an example of what I'm talking about when I talk about random chance, then how we can actually run analyses to give us an idea of if something is real or maybe just due to random noise. So let's talk about a scenario here. So let's imagine that you see an influencer over on X and they say something like this. They say, I discovered this magic indicator. It has flashed 3 times recently for some coin, let's say XYZ here. And then XYZ did an average of a 5x within a year after each time. And then they say that just flashed for Bitcoin, so it's time to go all in on Bitcoin. Now, this is not too far off from the type of things you probably have seen on X. A lot of people will take very small sample sizes with one asset and then generalize that to say that it must apply to everything. And the question then is, how can we evaluate whether or not something like this is just due to random noise that this person is claiming that this is an average of 5x return, or is this some actual meaningful signal? So let's just imagine that we are omnipotent and we actually know what the true distribution of returns are following this magic indicator signal. So in the real world, we wouldn't have access to this. We wouldn't know what the full population or realm of possibilities for returns are after some signal. Let's imagine that we do. And let's imagine that in this case, that signal is actually worthless. That in reality, kind of the objective sense, if you knew the full picture, is that on average, the return after that flash is 0. That it's just as likely that you'd get a positive return as you would get a negative return. But yet this person observed a positive return. They told you that they'd observed this 3 times, and on average, it was a 5x return after that happened. How is that possible if the true actual average return is 0? Well, it has to do with sampling, and with this case, a very limited sample, and getting a biased sample, an incorrect sample. So let's imagine that this person, the times they observed happened to be one case where it did a 2.5x, the other time that they had sampled happened to be a 5x, and the other time happened to be a 7.5x. So on average, this would be a 5x return. But importantly, this is just because they happen to have gotten samples from this side of the distribution. They very easily could have gotten this kind of a sample. Maybe if they looked at a different asset or over a different point in time, where it actually price went down by a factor of 6x here, or down by a factor of 2.5, and then maybe one case where price doubled, went up by a factor of just 1x, whatever the current price was. And so this would show up as being a negative return. And then of course the person probably wouldn't have talked about it as being anything meaningful. And so this is an inherent issue, especially with small sample sizes, that you don't know what the true distribution of returns are. And so what you're doing is you're taking some sample and then you're estimating what the true kind of average return might be. And in this case, they just got it really wrong. They got a skewed sample that was very much on the positive side, which led them to an incorrect conclusion versus if they had gotten a larger sample. And so then the question is, with golden crosses and death crosses, are we doing something similar? So people who say that golden crosses lead to positive returns in the future, is it the case that they're either accidentally or on purpose just cherry picking times when golden crosses led to really high returns? Same with death crosses. Are they just happening to pick instances where it led to a really negative sample and ignoring all the ones that might have been on the other side? Or is it the case that they actually are predictive of different returns? And then additionally, the question I think we're really interested in is, are golden crosses and death crosses actually different? Or is it just random chance? And so to put this back in our example, maybe people who have talked about golden crosses being a good thing have just done this. They've happened to sample from this side of the distribution, but in actuality, golden crosses are not actually leading to anything positive. Maybe the actual average return is just 0. And the same thing with death crosses. Maybe they just happening to sample from this side of the distribution, when in reality, the actual average return or median return would be 0. And so this is where something called inferential statistics can give us some idea of if this is going on. To basically get an idea of, can we be at all reasonably sure that what we're observing would be pretty unlikely to happen if it was just due to random error, and so it actually might suggest that there's something meaningful going on here. And so basically what I'm going to be showing you here is some analyses where we're going to estimate how likely it is that we'd observe, in this case I'm going to focus on median returns that Jay had just talked about, if death crosses and golden crosses actually were providing 0 signals. So basically if it was just due to random chance, how likely would we have been to observe what we saw? And if that's super unlikely, we might be able to say that, okay, it probably isn't just due to random error, it might be actually something meaningful in the markets. So let's go ahead and break this down. So what I did is I constructed a number of different inferential models where we use a few different predictors here. So one of the predictors that we're going to use of, in this case, median returns is what type of cross did we observe? Was it a death cross or was it a golden cross? And does that matter? We're going to talk also about whether or not price is above or below the 20-week simple moving average to see if that matters. And then we also have this interaction term. Ignore that for now. We'll get back to that in a minute of what that means. For this analysis, I'm only looking at the top 300 coins, so only focusing on relatively larger coins. So then finally, I'm going to be only looking here at median returns. Average returns can get very skewed if you have small cap assets that do a 10,000x move, for example, then that can really skew your distribution and skew your means. So medians help get rid of that. Medians are a lot less sensitive to outliers. Let's go ahead and talk about what we see. So this is going to look kind of complicated, but let's go ahead and walk through it. It's actually not too bad. So what I'm showing you here are the different return lengths. So this would be the return 10 days after a golden or death cross, 20 days, 30 days, 60 days after either one of those events. We then have our different predictors. So cross type would be golden cross or death cross, and then this would be above or below the 20-week. And the important thing that I want to draw your attention to is these what are called p-values. You may have heard of this before. Basically what a p-value is telling you is how likely would you observe some effect, in this case some difference between golden crosses and death crosses, how likely to be to observe that difference if there was actually no difference at all, objectively speaking. So assuming that golden crosses and death crosses actually have no difference in their median return after 10 days, how likely would you be to observe the actual difference that we might have observed? And we did see there is some small difference. How likely would we be to see that? And so what this is a probability. It's just basically telling you what is the probability to observe whatever you saw if it was actually just random chance, if there was actually no difference. And so what we can see is that, for example, for the 10-day median return after a golden or death cross, what we can see is that there's an 87% chance, a little above that we'd observe that small difference that we saw between golden crosses and death crosses 10 days after the given event. And so basically what that's telling you is that there's really no difference here, that after 10 days, whether you got a golden cross or a death cross, there's really not much of a difference. Either one is going to be basically the same in your expectation of what the return are. There's no differential prediction there. Same thing with being above or below the 20-week when a cross happened. It's super likely that any of the observation that we had was just due to chance. And so really when we look across these different lengths, we're seeing there's really not much of effect of anything going on over here, or at least the probabilities are high enough that's just due to random error that we wouldn't really want to conclude there's actually something meaningful going on here. But things look a little bit different when we look at the longer lengths, and this, particularly the 180 days and the 365 day after the event returns. What you can see here is suddenly you see these p-values that are very small, that are saying that to observe what we observed is quite unlikely if it was just due to random chance. There seems to be that there might actually be some meaningful difference here. So let's go ahead and visualize this so we can break it down more, and then we'll also talk about what these interaction terms mean. So here is the median 180-day returns following a golden cross or a death cross, and then broken down also about whether or not that golden cross or death cross happened below the 20-week SMA, so when price is below the 20-week SMA, or when price was above the 20-week SMA. And the reason that we care about this is that if you're below the 20-week SMA, that's probably a more bearish time in the market. Whereas if you're above the 20-week SMA, that might be a more bullish time. So it's a contextual factor. Is the market bullish or bearish overall when these signals are flashing? And what you'll see is, interestingly, this massive outlier stick here, this outlier bar, which is when you get a death cross that's above the 20-week SMA. So when price is above the 20-week SMA, but you get a death cross, then you expect pretty high returns. So in terms of median returns, you're talking almost 350% median return following that signal. Then importantly, when we look at death crosses below the 20-week SMA, they are a bit above zero, but not too much. And then especially when we look over here at golden crosses, we see that there's really nothing going on here, that they're basically right around zero. And on average, you're not really going to be able to expect much. You're just as likely to be getting a positive return pretty much as you are to get a negative return. And these two bars that you're seeing here that kind of extended above and below, that's called a confidence interval. And basically what you can think of that is that if we did this whole thing in 1,000 different worlds and we did the same procedure, you'd expect these estimates to fall in between these levels 95% of the time. And so what that interaction was telling us here, this interaction term, is basically telling us that there does seem to be an effect of getting a death cross or a golden cross, but it depends on whether or not you're above or below the 20-week SMA. If you're above the 20-week SMA, then ironically, a death cross is diagnostic of actually really positive returns, whereas a golden cross is not. But then if you're below the 20-week SMA, there doesn't really seem to be very much difference between a death cross and a golden cross. They're basically right around zero, not really telling you anything too spectacular. And we see the exact same pattern, a very similar pattern, when we look at the 365-day returns following some kind of a cross. So again, if you're above the 20-week SMA and you get a death cross, that's when you're really expecting these positive returns, but golden crosses much less so. And then if you're below the 20-week SMA, it doesn't really matter. You're just not really doing anything at all. And the importance here is that when we look at this, what we can conclude is that for 180-day and for 365-day, it seems like there is something that's going on beyond what we just expect due to random chance. And what seems to really be standing out is this effect here, that when you would get that death cross when price is really bullish, when you're above the 20-week simple moving average, that seems to be a case where there is actually maybe some meaningful signal of getting some meaningful return. But in the other scenarios, there's really not much difference at all between death and golden crosses. And then especially when you're below the 20-week SMA, there's really nothing going on there as well. And I think this is really useful insight, because what you'll see a lot in the crypto space is people saying, look, here's a sample size of 3 of this indicator in the past. It just happened again, so this means we must go on some crazy rally or we must fall off a cliff. But if you understand inferential statistics, you'll understand that when you have a sample size that's that small, then it's probably not all that diagnostic of the future, that this person could have just been capitalizing on random chance with this indicator they discovered. But then when you can use inferential statistics, when you have a large enough sample size to get in and actually be able to get an idea of, is this just due to random error, random chance, random noise, or is there actually a real signal, and give you a better sense of the dynamics in markets. So you wouldn't expect to see this super often probably, but when it happens, it seems like it is related with outsized returns. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us over on X. Also, make sure to go check out Jay over at Daily Crypto Analysis if you have not already, and check out our website, which is a joint venture between us here at Upside Down Data and Jay over at Daily Crypto Analysis, claritydigital.io, where we have live data from our models and more.